Good morning, ladies and gentlemen. Let me kick off just by thanking John and CEDA. We are all grateful being here today. CEDA do a great job, not just here in Western Australia, but across the country. And it's important to have the debates and the policy discussions that we are having this morning. So thank you, John. My presentation will be somewhat different. Unlike the previous speakers, I have lots of slides and they're complex and full of data and numbers. That's the way bankers are, I'm sorry. But the topic does lend itself to that. So what I'd like to talk about is I'd literally like to fly around the world and look at the state of the globe from a financial perspective. Start with China, move to the United States, then Europe, then Australia, work back to Western Australia, and work back to an industry that's important to us here, and that's natural resources. Oil and gas, energy, mining and metals. I will try not to make it depressing. I'll certainly attempt to do that, and I think by and large the news of where we are is not all that bad, so it should certainly find its way that way. Let me just start with what we do, Macquarie. I'm sure Macquarie Group is known to most of you. These days it is largely an overseas organisation. We have our heritage here in Australia. We started in 1969. These days, most of our revenue and income is from overseas. $500 billion in funds management. As I said, it's largely an organisation that's exported itself overseas. A great success story for Australia, really. It's not that easy to do that from a country where we are. Nearly 14,000 people. We're in 28 countries and have nearly 80 offices. A good story of growth. I didn't make that chart up. That's actually the real numbers, and pleasing to see how that's occurred even compared to our competitors here in WA. Look, I won't go through all of this, but we do a lot here in WA. We are very much committed to the state. We have nearly $6 billion if you just look at our auto leasing book, our residential mortgage book, our business banking book. So very much committed here, have nearly 200 staff and have been here for 25 years. So we begin our journey. If I can get this to work. Okay, China. There has been a lot said on China, and clearly where we are today is that there is somewhat of a crisis of confidence, and the world moves very rapidly depending on the news that comes out of China. Three factors, I think, in the last 3 or 4 months have driven that. The first is what's happened with their own currency, multiple devaluations which were expected by the market. The second is their own equities market. Have a look at the time frame on that middle chart. That's from January 14 till today, and try and look at the scale of how that's moved up and down. Equity markets don't historically move up and down several-fold over 1 to 2 years. And whilst both indexes have come down, they are still materially above where they were 2 years ago, but that causes enormous volatility. The last slide is one of country capital flows, not something we talk about a lot, but anyone can picture that graph and see that there's an issue, and the issue is that capital flows and declining reserves, capital flows outside of China and their declining reserves, the three of those factors actually leading to this volatility. That is a basket of volatility indexes that comes out of Macquarie Research. We put it together. It goes back to January 08. I wanted it back there because you can basically have a look at what's happening today relative to where we were in our global financial crisis. You'll see that up till about 12, 15 months ago, there was a period of stability, not much volatility. And that was back when our own All Ordinaries Index was at around 6,000. We are back in the high 4,000s today. But you can now see what those three factors and a few other issues in China have led to where it is. Always good, though, to put things in context. And whilst China has clearly slowed down, our economist has it growing at between 6.5% and 7% this year. It is still doing well on a global scale. That GDP number on the left, you have to go back to the 80s to when China grew at less than 6.5%. So 6.5% is high. It's high by any Western standard. You only have a few large nations, probably India, that are actually growing at a faster rate than that. What you are seeing in the middle, though, is quite a healthy chart, and that is the move to a consumption-oriented economy. The proxy for that is the proportion of GDP in the economy that is driven by services, exactly how a country like the US, mainstream Europe, Australia would be. That's an important graph because eventually China will have to grow from its own engine internally, consumption-driven growth. And lastly, house prices came off a lot. They're starting to come back. And for those of you, and I'm sure many of you travel to mainland China, you can feel it. There's concern about the equity markets, but real estate's actually doing okay. So we then move to the rest of the world, and this is really a story about North America, the United States, and Europe. The biggest issue faced at the moment is deflation, an issue we haven't had to grapple with over the last 20, 30 years around the world. But what we are seeing here is that the US is doing well, I'll come back to it, but the view of where the Fed will take interest rates has come off a bit. Go back to before Christmas, I think all the futures markets were telling us, you can backward engineer what the futures markets are telling us, that there would be 4 rate increases. I think now it's viewed that there'll still be 1 or 2, but unlikely to be another 3 to close out their rate cycle. There are economists in this room, I see several here. That is an unusual chart, that one on the right. Negative interest rates is not something we've become at all accustomed to. And we are now seeing it in Europe, we are seeing it in Japan, Sweden, we will see it in other countries, and that is one of the issues. We are trying to stimulate consumption. We are trying to stimulate consumption because we need to inflate economies. We're needing to do that because we're basically in a period of deflation. This got there. It is not such a bad sign though. And this chart is a counter to those last 3 slides. The counter is to effectively look at the United States, then look at credit growth, and I won't spend too much time on that last chart. The United States, unemployment back in 2008 was nearly 11%. Today it's 4.9%. And just as importantly, because I will come back to it when we talk about Australia, earnings growth is occurring. Very important factor. So yes, the US has its challenges, but it is actually doing okay. You don't see many employment alterations and changes like that unemployment rate on the left, moving from 11% to 5% in half a decade. Credit growth, that is a very good sign. Sue did mention that credit is being released. It is being released. It's being released in Australia, probably not as much here in Western Australia, but certainly in Europe and the US. You can do that as you run deficits. You can do that as you borrow. That's one of the issues. But where I land, I think, is that the US is really going against most of the world, quite frankly. It is looking to increase rates and has a monetary and a fiscal policy which is slightly at odds with the cycle of the rest of the world, but we need it. We need one part of the region of the world, which includes China and will certainly include India, that is doing well. Okay, we work our way back home. Australia. In many respects, I think those slides sum up where we are in Australia. Mining investment has clearly come off as a percentage of GDP. We see that. Important to note, though, that although it has come off, it is not back to the level of where it was even in the year 2000. So yeah, it has come off as a percentage of GDP, but less so than where we were. GDP per capita and gross domestic income per capita. The first is a very good tale. I mean, if you have a look at GDP, Australia is now 20 to 30% higher than most Western nations in terms of GDP per capita. That middle slide, you can see the base from 2009 until today. It's increased rapidly. Domestic income, though, has fallen. That is not a good sign. And when you hear politicians talking about an income recession, it is exactly that we have GDP per capita increasing, but we're not seeing it occur through income growth. Part of that is a population issue. We are growing less as a country today. We're growing far less here in Western Australia. If we'll come back to it, but we had growth of nearly 4% not long ago in terms of population to where we are now. Our labour market, again, we'll come back to WA, but our labour market's actually held up okay. If you go back 18 months ago, the forward estimates on unemployment were not 6%. As Sue correctly noted, that hides a lot of data at the micro level, but overall, we have actually held up relatively well in terms of where we are in terms of unemployment. So Western Australia, we all live it, so we all know it, and we all have our anecdotes. I do like starting with that left slide. The left slide is important because it should remind us that we have had a remarkable period of growth, which it's difficult to see in a 15-year period in a Western country where that's been mirrored. If you go back the last 13 to 14 years, GDP has averaged about 5% in Western Australia. Having that occur for 1 year is fortunate. Anywhere the size of the state, 2 or 3 years is remarkable. Close to 15 years, as I said, it is difficult to find. And hence, you need to put today in the context of what has occurred. GDP per capita 15 years ago in this state was 20% below the Australian average. Today, it's 45% above the Australian average. It's been a remarkable change in the wealth of the state in a macro perspective. Today, GDP is certainly below the Australian average. If you speak to CCIWA, they have some very good data with James, their chief economist. We are probably at somewhere between 1 and 1.5% GDP. We are not in a recession. No piece of data would suggest that we are. In the middle chart, unemployment, though, is starting to come off. Today, as we speak, we are actually under the Australian average. Last week, employment data came off. We're at 5.9% unemployment here. The Australian average is 6%. It doesn't feel that way, and it doesn't feel that way for most of us when we walk around. They are the numbers. This on the right, we clearly know. If you go back to 2007, state debt was below $5 billion. Today, we will quickly get to the point where it's above $30 billion. Let me say we should have some state debt. There is an optimal level of debt a state and a country should have, just like an organisation. It is not zero. We are also fundamentally a much larger organisation than we were 7 or 8 years ago, and as a result, we should carry more debt. The right number is not 30, though. It is a number certainly less than that. This is a question that I just hear bandied around a lot, and so I do like to put it up. Did we squander the investment boom that we had? Did we squander a long period of wealth in our state? And again, we all have an opinion. It's often helpful trying looking at the facts. The facts suggest that we probably didn't. We didn't squander it. If we have a look at a number of indicators, the proportion of the state economy that is still driven by mining, it's permanently increased. If we have a look at iron ore, LNG, very important for our state in terms of the volume that we're putting out, it's a very different story. They are permanent changes They will generate wealth in this state for decades to come, and it's easily forgotten. It doesn't mean that we're not experiencing a period now which is challenging, but it's worth keeping in mind that in terms of the mining boom delivering permanent changes, we certainly have had some delivered. This is another way of looking at that. I'll lead you to the last two slides first. They are effectively, the middle one is the proportion of the ASX 200 index that's occupied by mining, metals, oil and gas companies. The one on the far right is the industrials index compared to the mining index. If you were Rip Van Winkle and went to sleep in the late 80s and woke up today and looked at that far right chart, it's as if nothing happened. The proportion of the Australian financial composite index that's occupied by mining is about now what it is in the late 80s. And the middle chart basically says the same. The first chart says something quite different though, that there's been a permanent increase. If you look at the Deloitte's WA index, the gross market capitalisation of all companies that have a head office here in Western Australia, there's been a permanent increase. That is good. That means we have added net wealth here in Western Australia, notwithstanding the fact that there's been a major adjustment in our indices. It does also beg the question as to whether, because there is a disconnect between that first chart and those other two, that the impact of the commodities downturn has been overplayed in terms of share prices. And I think it has, and I think there'll be a run that occurs as a result of it. One of my favourite charts. The Economist Intelligence Unit and Monocle both put out rankings of the most livable cities every year. I know what you're thinking when you look at the Economist Unit. Any organisation that ranks Adelaide ahead of Perth should be discredited. Clearly a major flaw in the argument and credibility of that organisation. But if you do have a look at it, there's a point that does jump out, and that is that we in Australia are well set in terms of the quality of the cities and the infrastructure that we have. If you have a look at the Monocle one, I think we were ranked 14th or 15th. And Adelaide, I think, was in the top 20 as well. So you do have to put that in perspective. That is a reminder that the rest of the world, as they look at all the criteria that ranks where we sit in terms of quality of destination, quality of living, and it's a compilation, as I said, we do very well. Okay, I will spend a little time on this chart. Let me just explain the chart. The chart is effectively an outlook on Western Australia. It is along several measures, which you can have a look at, from micro inputs at the top to outcomes at the bottom in terms of GDP and unemployment. And I've tried to look at it three ways. Firstly, how are we today in Western Australia compared to, say, 18 months ago? Second of all, comparing ourselves to the rest of the country. And third of all, I look forward. This is, effectively my views based on Macquarie research and what I personally see around the world. Those circles, the more shaded they are, the better. So if they're empty, bad, full, good. And I won't go through all of them, but I think you can compare where we sit to a year and a half ago and then where we sit to Australia. So ones that jump out for me is a key element, and that's business and consumer confidence. Our business and consumer confidence is clearly fragile at the moment. And it is very fragile compared to where it was 18 months ago, and it is certainly fragile compared to the rest of the country. If you as many of you would go over east, quite a different vibe, different view. Very much the reverse of what it was 3 or 4 years ago when our wise visitors from the east would come over and see us. And It was very much a tale of two cities then. It is now. It's reversed slightly. In terms of house prices, nothing surprising there, I think. I mean, clearly in the last 18 months, house prices have come off. Last year, 2015, you have to go back to 1991 to see a year where residential real estate did worse in Western Australia. That shouldn't be interpreted as a bad sign. My view is that real estate has bottomed. It's a leading indicator and often driven by the first measure, which is business and consumer confidence. So my own view is that we will see a turnaround there. Unemployment, we are clearly not doing as well as we were several years ago. We were at 4% at one point. We're obviously now at 5.9. GDP per capita, we are still doing well. My strong view, though, is that if you move to the look forward compared to today, I think we are probably at the low point in terms of how we're doing as a state. Taking a compilation of indicators, I think there's more reason to be optimistic going forward than not. I'm just going to finish up on a few slides on commodities. Most people here, nothing new there. When you go around the world and you put that slide up, it's an epiphany, let me tell you. I mean, many people around the world in business just do not understand the capitulation that has occurred in natural resources over the last few years. This is a story that started playing out in late 2011 in mining and metals and commenced again in 2014 in oil and gas. You know, in the natural resources world, there is a saying that the intensity and duration of a hangover is directly related to the intensity and duration of the party. And, you know, we had a long party. And you have a party like that, there is going to be a hangover for a while, and we're experiencing it now. The point I would look is the bottom line, which is most of these commodities are at decade lows. In real terms, because they're nominal prices, even more so. And several of them are at historical lows. And it's happened quickly. So when we feel pain, no industry can adjust that quickly. No industry has the mechanisms and the tools to not experience what we're experiencing in this state when that occurs. And hence, it shouldn't be a surprise. We shouldn't have or feel fear from it. We should react to it, and we are reacting to it. But there's no surprise that we find ourselves where we do today. Why we're there? It is much more about supply than it is about demand. Demand has come off. It's not really a demand story. It's about supply. Supply, when you have such a long period of time of high prices, has plenty of time to fund itself and come on. But it comes off very slowly. Boards, management teams, as we know, do not look to cut major projects all that quickly. So the story is about supply. What is good, though, is supply is now starting to come off. We are seeing it, and we are seeing it actually work its way through commodity prices today. What we are seeing at Macquarie, we've gone through the first theme, which is in most organisations in this state, cost reductions. The good news is I think that's just about at an end because it's gone on for a long time. There won't be much more to squeeze out of it. There hasn't been a lot of activity for the lawyers and the accountants and the bankers in the room because there hasn't been a lot of transactions. Again, I think we're starting to see that change. The bottom point is probably the best one, and that is that what we, Macquarie, are seeing in our pipeline of work is increased activity. We are seeing increased activity because the market is starting to become stable. It's not rising, but you don't need a rise in commodity prices to have stability and lead to activity. And I think that will lead to confidence where there'll be rehiring, expansion will occur, organisations and boards will have the confidence to actually spend on CapEx, write cheques to actually grow. And that is quite a different mentality than where we've been. You know, what we are seeing in a lot of boardrooms is chief executives now asking, we've done the cost reduction, we've cut everything, We have to think about growth. How do we do it? My last slide, I'll come back to where I started, which is a summary of where we are around the planet. Growth globally, just under 3%. The 3.6 is on a purchasing power parity adjusted basis. There's nothing that predictive in that. The planet has grown at 3% for most years for the last 50 years. It had 1 year of negative growth in 2009, but it does that year on year, and it manages to find ways to do that year on year. China, I think we are experiencing a soft landing. I think the days of a hard landing are gone, but the view is 6.5 to high 6% of GDP growth. The US, my view is probably 1 rate increase, if not 2 this year. I think the Fed is trying to adjust the market for where it's at. GDP in the mid-2s, certainly no more than that. Europe, I actually think, is a positive story. It will do growth, which is still low by historical standards, but a long way from being in recession. Countries like Spain, for example, are doing extraordinarily well at the moment. Spain is growing by 4%, which, given where it's come from, actually is quite remarkable. Australia, transition's occurring. We're hearing it, but Australia, it will not be in the next year or two that we will not continue our period of growth. There will be a time when it comes, but it's difficult to see it occurring in the foreseeable future because the economy actually is still quite resilient. And WA, I think WA has a period of adjustment. It is now for the next 12 to 18 months. We will come out of that. The economy is already starting to show signs of doing it. We have some big things like state debt we have to fix. But within the context of doing that, I actually think there's reason today to believe that the next 18 months will be better than the past 18 months. And commodities, from where we are, it's crystal balling, but my view is given supply that is coming off, that you can see coming out of the market, there is more upside than downside. The risks are to upside and not downside. If I had to pull one out, I know Andrew Smith is here, I'd probably take oil. I still think oil is in a position where there is still adjustment to occur there. But otherwise, if you take the globe as a whole in terms of financial markets, I think we'll also see a period in the next 3 to 6 months of much more stability in financial markets than we've seen. On that note, I'll say thank you and take questions when I'm sitting down. Thank you.